morning to you all. Welcome from Mentor House, Blackburn, to our first virtual budget breakfast presentation. I hope you breakfasted well and we don't now give you indigestion. However, in these times of great uncertainty, we provide you with the reassurance of your favourites this morning: Anne Wilson, our Senior Tax Manager, and Nadeem Hussain, our Head of Taxation. And this year, a new favourite, Lisa Kennery, our Head of Payroll and Marketing and champion of furlough claims. A year ago, we were at Ewood Park commenting on a budget speech that did not even include the word furlough, but did allow some 30 million of fiscal support to tackle the virus. Of course, what was expected to be a temporary disruption to our way of life has fundamentally altered it. In our lifetimes, we may recall HIV, Ebola, SARS, avian flu, and maybe others. And we all thought COVID-19 would follow the same path, and how wrong we all were. Now, I read last weekend the words of Philip Hammond, or Spreadsheet Phil, as some of you may remember him, who was Chancellor of the Exchequer for Theresa May. He commented that dealing with the pandemic has been the financial equivalent of fighting a war, a theme also referred to by Mr. Sunak in what was his second budget speech. He set out a three-part plan for his budget. Firstly, to continue to project jobs, livelihoods and businesses, reiterating they will do whatever it takes, which was their promise to us prior to the general election in December 2019. Thereafter, to fix the public finances and begin to build the future economy. As ever, Mr. Sunak was impressive throughout, highly intelligent and articulate, providing explanations for the past and sharing his strategy for the future. Now, with the vaccination programme working and in full swing, he confirmed the cautious but irreversible roadmap out of lockdown, and that the Office for Budget Responsibility, the OBR, now expected a swifter and more sustained recovery than it did last November, and they believe we will return to pre-COVID economic levels by the middle of next year, 2022. The OBR expect economic growth of 4% this year and 7% next year, which is very strong, albeit thereafter, disappointingly for me, it flatlined at 1.7% for the following 3 years, albeit that doesn't reflect the announcements made for building the future economy. So furlough is extended to September for employees, with 2 further grants for the self-employed, now sweeping in the 600,000 or so who had started new businesses but not yet filed tax returns, so missed out on the initial support. I must say that throughout my career, preparing proper accounts, submitting tax returns promptly and paying the tax due on time has never let anyone down. Now, if I were to offer one piece of advice to you entrepreneurs starting up in business, then that will be it. Additionally, there will be cash grants and restart grants for those businesses forced to close for slightly longer, those in retail, hospitality and leisure, plus further rates relief and an extension of the 5% VAT rate. With bounce back loans and C-bills coming to an end, there will be a new recovery loan scheme providing new loans from 25,000 through to 10 million up until the end of 2021. He then moved on to part 2, the fixing of the public finances. First, the damage. Now, the mixture of furlough, other pandemic help schemes and falling tax takes has left us with a national debt of 2 trillion, that's trillion, which is 90% of gross domestic product and a level not seen since the early 1960s. Now, the public debt was 500 billion prior to the credit crunch in 2007-8. I bet you're now trying to work out exactly how much is a trillion. Well, like a million is 1,000 thousands, like a billion is 1,000 million, a trillion is 1,000 billion. And what do you call 1,000 trillion, you might ask? I think the answer to that is the doomsday scenario, Armageddon, Good Night Vienna, or a Mowbray death slide, depending on your point of view. So the balance of payments or public borrowing requirement in the last 12 months has been 355 billion, which is 17% of our national income. Now, I recall it being around 180 billion when the Conservatives took office, after Tony Blair and Gordon Brown, and they'd managed that down to around 50 billion through the years of austerity. However, where does the money come from? Given the years of austerity and the unmet demands for more for the NHS, well, it's the sale of government bonds to the financial institutions, pension funds, the Bank of England, and even private savers. For example, during the quantitative easing after the credit crunch, the Bank of England bought 875 billion of government bonds. Now, these bonds are seen as completely safe as they are HM government backed, and they vary in term from 1 day through to 55 years, although there have been no perpetual bonds issued since 2015. Mr. Sunak acknowledged that the 355 billion shortfall was the highest since World War II, and with a planned further borrowing requirement for 234 billion this coming year. However, both Hammond and Sunak seemed relaxed in that it's unlikely there's anything dramatic you're able to do to reduce it. And what really matters is the relative size of the debt to the economy. So if we now grow the economy, as after World War II, the debt is manageable, remaining the same in absolute terms, but a much smaller percentage of the national economy. However, Mr. Sunak did stress that what we cannot do is borrow to meet our day-to-day expenditure, and that it will be irresponsible not to now check the increase. Indeed, we've been fortunate to have had 10 years of good Tory husbandry to have the fiscal freedom to act as he has done. He will not reduce spending on the public services, as they are the party of the public sector. And so to the tax rises. There's a general freezing of allowances, which has been criticised as punishing those least able to afford it. My colleagues will share the detail of that with you later. The biggest shock was a dramatic increase in corporation tax, from 19% to 25% for larger companies from the 1st of April 2023. Robert Peston believed that this and the continuing financial help against the effects of the pandemic were the two standout messages from this year's budget. Whilst entirely understandable, it is a shame that the long-term planning of David Cameron and George Osborne to increase the rates at which basic and higher rate tax began, together with lowering the main corporation tax rate from 28% to 19%, that had taken years of gradual nudging to get to, were reversed to the stroke. Years of good work undone by the virus. However, as Mr. Sunak referred, it's going to be the work of many governments over many decades, of many generations, to pay the increased debt back. So we then turn to part 3, an investment-led recovery. Firstly, a new UK infrastructure bank in Leeds to fund the green industrial revolution, lending up to £12 billion and unlocking a further £40 billion of private investment in infrastructure. Secondly, the super deduction, enabling all capital expenditure to be notionally enhanced and then allowed as a charge against taxable income. And thirdly, the scientific superpower. Buoyed by our development and then implementation of the vaccine, there's a strong desire for high growth innovative companies to make our R&D and EMI schemes internationally competitive and to ease the obtaining of visas for highly skilled migrants. It is acknowledged that high growth firms need access to capital, and Lord Hill has undertaken a landmark review and made proposals to the pension industry to give them more flexibility to unlock and invest pension fund monies in innovative new ventures via the Future Fund Breakthrough. The FCA is to be consulted shortly on his proposals. Now, whilst the theory is exciting, the potential for a double whammy of pension fund growth whilst establishing new industries, this must be a gamble. Should those new businesses not succeed, then people's pensions will have been lost. And what about displacement? What happens to those industries and businesses where the pensions money is currently invested if those monies move elsewhere? So I look forward to seeing what the FCA makes of it all. Additionally planned is a new retail savings product to support green projects and a task force to establish the city as the global leader for carbon offset markets. The Chancellor re-emphasised his commitment to the UK as a whole which he stated was not a political comment, but the actual reality of where we are, explaining how all regions have benefited from the sports schemes to date, announcing new investment projects in Scotland and Wales, such as the wonderfully named Aberdeen Energy Transition Zone and the Holyhead Hydrogen Hub. So those names have come a long way from, say, the National Coal Board, their NCB logo on the back of a donkey jacket, now an iconic symbol of the industrial decline and trade union discontent of the 1970s. Additionally, there's £1 billion to be shared between 45 UK towns, including Bolton and Preston. And now we're out of the EU, 8 new free ports, our nearest being Liverpool City, with others in the East Midlands, Felixstowe, Humber, Plymouth, Solent, Thames and Teesside. Now these free ports are going to be done on a scale never seen before, creating investment, trade and jobs. They'll encourage free trade and demonstrate we're an outward-looking nation open to the world. There'll be special economic zones with different rules, be easier to do business, cheaper customs duties and tariffs and lower taxes. Let us hope they really do as Mr Sunak promises, replace our past industries with green, innovative, fast-growing new businesses. The already established and growing commitment to the regions is welcomed by all, with the Treasury now committing to establish an economic campus in Darlington. Mr Sunak confirmed the highest levels of sustained public investment since the 1970s. The financial markets have acknowledged the budget as a pro-growth fiscal announcement, focusing on the economic recovery, looking to spur on investment rather than turning off the fiscal tap. It's believed this will help to underpin the pound in the medium term, with sterling already a notable outperformer in 2021 to date. The market reaction itself has been quite limited, given the significant amounts of detail that already been reported in the UK press and already factored in. The Financial Times headlined with a spend now, tax later plan. The Metro renamed the Chancellor Risky Sunak. As ever, we shall see. In reply, Sir Keir Starmer opened with a jibe at Boris that fell flat. He said it was nice after 11 months to finally be opposite the man running the country, meaning Mr Sunak, although his decisions had left us in a mess. Indeed, he stated there had been a decade of Conservative neglect, and having heard Mr Sunak's plans, that they don't understand the next decade either. Nothing about social care, papering over cracks and not the foundations. So it was political theatre at its best. And unfortunately, we couldn't lip read behind Mr Sunak's mask. Finally, there's support for a UK and Ireland joint bid to host the 2030 World Cup. So let's hope it's coming home. So that's a brief overview of the headlines and the economic and political sentiments behind them. We're now going to move on to some detail and closer analysis of what it means for our clients. Now, if you have any questions, please put them into the drop box as the presentation continues, and we will deal with those at the end. So I'll now hand over to Anne Wilson. Thank you.
Good morning. This is very strange, partly because it's the first time in about 12 months I've worn a dress and lipstick, and when I got ready this morning, I looked at myself and I thought, oh, I look like Grayson Perry. Anyway, thank you to John for that excellent overview of the budget. And I just want to start with a look at what hasn't changed. There's more than one way to collect taxes, and although the rates of tax haven't gone up, additional tax will be collected by stealth, hence the picture of the stealth bomber, because personal allowances and rate bands are going to be frozen through to 2026. There were no changes to the dividend allowance, so the first £2,000 is still at 0%. No changes to the savings allowance. The inheritance tax thresholds have been frozen yet again, so the nil rate band remains at 325,000. And I've got a question which you can answer in the chat box. When was the last time the nil rate band changed? And I'll give you a choice of dates: 2009, 2012, or 2015. So have a go. I'm afraid Piers Employees and their families cannot take part in this competition. Answers on a postcard, please. And there's no prize, I have to say. The capital gains tax annual exemption was frozen through to 2026. VAT thresholds have been frozen, which is perhaps a good thing for some businesses, I don't know. And the pension lifetime allowance has been frozen through to April 2026. Now, I did hear someone on the radio this morning, an IFA, saying that in a way it's a good thing because at least they've got certainty and they know how to plan for clients. It's easier having that certainty about the pension lifetime allowance. So that's just a brief overview of how to collect more tax without actually raising tax rates. Making tax digital is coming. It's been kicked into the long grass on several occasions, much to my relief, I have to say, because I don't think I'm looking forward to it. It's currently in force already for VAT registered businesses who have been reporting online since April 2019 with the help of our online services department, who are geared up for the next stage in April 2023. Now, from then, landlords and unincorporated businesses, including partnerships with an annual turnover of more than £10,000, will have to report quarterly details of their income and expenses, and they'll be provided with an estimated tax calculation each time to help them budget with tax payments. I suspect this is a move towards quarterly payments for income tax eventually. The reason for making tax digital, one of the reasons was so it would dovetail with universal credit claims, but I think it's just a way of getting everybody on board, making it more difficult for people not to pay their tax. Having done your 4 quarterly returns, you then got to do a final return, and on that final return you would include other income, any capital gains, any claims for tax relief for pension premiums, that sort of thing. On the subject of pension premiums, just to diversify a little bit, it was a surprise that nothing happened about pension premium relief. It's still available, so keep on making those pension contributions, particularly if you're a higher rate taxpayer. Along with the Making Tax Digital introduction in 2023, there will be a new points-based penalty system for late filing returns and more onerous late payment penalties. Currently, for self-assessment, if you make your balancing payment more than 28 days after the due date, a 5% penalty is imposed. So the new penalty thresholds, this points-based system, it's a bit like your driving licence. If you make annual returns, the first time the return is late, you get 1 point. The second time it's late, you get another point, and then you get a penalty. If the returns are quarterly, you're given the opportunity to rack up 4 points before you have to pay a penalty for late filing. And if your returns are monthly, then you need to rack up 5 points before you get a penalty. The new payment, late payment penalties will actually kick in after the first 15 days. So if a payment's late after 15 days, then you will get a late payment penalty, unless you arranged a time to pay agreement with HMRC. Then the penalty creeps up to 4%, but then after 31 days, an additional penalty will accrue at 4%. So they're quite onerous, the late payment penalties. Moving on, I think it was a great relief, particularly to those people who are newly self-employed. As John mentioned, 600,000 people took up self-employment in 2019-20 and weren't able to claim the self-employed income support grant because they had no tax returns on which the payment could be based. Well, this final tranche of support grants will help those who are newly self-employed, provided they've submitted their 2019-20 tax return. They will be able to claim some grant. And the grants, you can claim the 4th grant from April 21 onwards and the 5th grant from July 21. and HMRC, as they did with the initial self-employed income support system, did actually contact people whom they'd identified as being eligible for the grant. But this final tranche on the fifth grant will actually depend on turnover reduction. So if your turnover hasn't reduced as a result of COVID, you wouldn't get the grant. If it's reduced by more than 30% in comparison to the previous years, then the grant will be as is paid now. But if it's reduced by less than 30%, you'll only get 30% of 3 months average profit. And they're obviously hoping that by September things will have picked up, fingers crossed. The other reform that's been kicked into the grass on a couple of occasions is IR35 for off-payroll working. Now, this was introduced to the public sector a couple of years ago, so anybody working for example, the NHS or universities, that sort of thing, through a personal service company would be caught by these rules. It was going to be introduced into the private sector last year, but that was put back because of COVID. So the reform, this is basically to stop people who are working as if they're employees of a company, avoiding paying national insurance contributions by using a company to invoice for their work, and then they extract their profits by dividend. The Revenue have been trying since the year 2000 to do something about these kind of arrangements, and they've failed miserably. They've lost an awful lot of cases in the courts, so they've decided, right, the only way to do this is to put the onus on the end user, so the client, and because the client knows that if they get this wrong, they will suffer the tax and national insurance deductions. They're now basically paying people who are working through personal service companies under deduction of tax and national insurance contributions, and quite a lot of companies are asking their contractors to complete forms, and I've got an example here, asking questions such as, in the last 12 months, have you carried out self-employed work of a similar nature for other companies? Do you currently provide services for a set number of hours? Do you use your own equipment? Do you take on all risks in relation to the services provided? How do you introduce yourself? You know, I'm representing this particular firm I'm working for. Can you provide substitutes? These are the sort of questions that are being asked. And a lot of contractors will find that they're going to receive a smaller fee for their work because the client is going to reduce what they pay them by the national insurance contribution. So 13.8%, they're going to be worse off. You might want to try and renegotiate with your client, but good luck with that one. Fortunately, the new rules only apply where the client, the end user, is a medium or large business in the private sector, and the definitions are on the slide. The slides will be available, so I won't go through those. If you're a small business, then you don't need to worry if you're engaging somebody else to do work for you. You don't need to worry about their status if they're working through a personal service company, because the service company remains responsible. The HMRC have provided it's called CEST tool and guidance, and you won't be surprised to learn that if you actually use the tool, it always comes out with the right answer as far as the HMRC are concerned. In other words, that you are caught by the rules. And most companies who are taking on contractors will be taking a great deal of care to make sure that they don't get this wrong. And unfortunately, if your client decides that you are caught by the rules, then that's the end of the matter. You can't really do anything about it. There's no appeal. We are actually presenting a webinar on the 17th of March on this topic, because there's quite a lot of information to go through. So that concludes my part of the presentation. I'd like to introduce Mr. Hussain, who's going to speak to you next on business matters. Thank you.
Good morning, everyone. This is unusual, isn't it? I was actually reflecting this morning about the last time I presented, which was at Ewood Park. Of course, a lot has happened since then. Been a difficult time for a lot of people, but there's also been some good stories. Best of humanity has come out. I must say, I draw the line when it comes to Zoom meetings and team meetings. The darker side of me comes out, and excuse the pun there. There's some people on Zoom meetings look effortlessly smart, no matter what I would expect them to be. Mr. Green is one of those. Whereas I have to worry about, is the angle right? Is the lighting right? Is the light bouncing off my bald head? Yeah. So I'm always looking for excuses to say that the signal's gone, so I should be on just an audio call, but perhaps it's just me thinking that way. But if you could support me with your messages on the chat box, that'd be appreciated. Anne was covering IR35 and other business-related issues. Just taking a step back, first of all, following the Chancellor's speech, there was lots of rumours leading up to the budget about changes to the rules. A lot of them haven't materialised, but there being no doubt those rises are on their way. There's going to be some more announcements on the 23rd of March with proposals for changes to certain tax rules. What they cover, we don't know yet, but we know there are changes afoot and tax rises. So people need to be prepared, even though at the moment there's been no changes announced. So the first business-related change, as John mentioned earlier, was the change to the corporation tax rates. And again, the rumours leading up to the budget were that there would be changes to corporation tax and that they actually would be immediate. So there's a lot to be grateful for that it's been deferred until 2023. So the headline rate will go up to 25%. Rishi Sunak made the point that it's still a very low rate compared to the G7 countries. Ireland, though, has still got the 12.5% rate. So some people do take the view that lower taxation will help actually grow the economy and actually fill some of the gaps created from the spend on the pandemic. But the government are looking towards higher taxes as a way forward. Although the headline rate is 25%, this actually highlights the situation we actually had a few years ago, where there was different rates of tax for small companies and larger companies. So as a result of the new rate and the smaller companies with £50,000 or below profits, you actually have a middle band between £50,000 and the eventual threshold of £250,000. And that marginal rate in that band is actually 26.5%. So a lot of you will be familiar that in past years, we tried to make sure we avoided companies, if we could, falling into that marginal rate band. So some planning is required. But if you, when we come to the new rates coming into play, pre-year-end planning will help minimise those tax payments. It mentions on the slide there that the thresholds are going to need to be split between the number of companies within the group. I'm advised though that they're going to widen that definition, so all companies under common control, so they don't even need to be in the same group, will need to be considered in deciding what the threshold how the threshold is to be split. Super deductions. I was intrigued by that description, but we've got a superhero there in the form of Danger Mouse, I understand. So the Chancellor highlighted that is keen for businesses to continue to invest, and with that in mind, expenditure on new and unused plant and machinery, so second-hand plant, etc., wouldn't qualify. And the headline rate, 130% first year allowances. It's worth just mentioning the difference between first year allowances and what we've currently got, which is annual investment allowances. And those rates, annual investment allowances stay in place, which currently, if you recall, stands at £1 million. But if you have qualifying plant and machinery from 1st of April 2021, then they will qualify for 130% of the allowances. It excludes cars, as you would always expect. One point though is that it also excludes assets that are used for leasing. And one of the implications there is that if we have any parent companies that own the plant and machinery and lease them to the subsidiaries, that purchased by the parent company of assets won't qualify for this 130% super deduction. So just to emphasise there that these allowances are effectively unlimited. They're separate to the £1 million of annual investment allowance. Brief example there at the bottom, a new machine for £100,000. It will actually rank as £130,000 in the capital allowances computation, and at a current tax rate of 19%, tax saved of £24,700 on a natural expenditure of £100,000. Just extending that further, certain elements of plant and machinery, usually expenditure on what we describe as integral features in a building, they don't qualify for the 130% allowance. It will be a first year allowance of 50%. Principles much the same as the super deduction. So the example below just confirms how that would work. Just by way of an example then, applying this situation where there's expenditure of £150,000 on land and £500,000 on the building of an appropriate property. So we know generally land doesn't qualify for allowances, so we can disregard that. But then the qualifying expenditure, the plants and machinery, we've identified of £40,000 qualifies for the 130% allowance, compared to 7,200 that would have been the case at 18% under the old regime. The integral features are dealt with separately. They now qualify for 50% first year allowance, and then we have the actual construction cost, the remaining £400,000 qualifying for structure and buildings allowances at 3%. So very quickly you can see that there's great encouragement to accelerate expenditure, and to know that it's in place for at least the next couple of years is going to be will allow businesses to plan accordingly. Recognising also that businesses have been incurring losses over the last year. The Chancellors introduced rules which are equivalent to rules that are currently applied to businesses that have come to an end and are using losses to carry back against previous profits. So under these arrangements over the next couple of years, there's going to be a facility to carry back trading losses for up to 3 accounting periods. And the carryback for companies is against their total profits, not just trading profits. Although there is a cap of carryback for the earlier 2 accounting periods, being a maximum of £2 million per accounting period. So that's going to be something that some businesses hopefully should be able to generate some tax refunds. It's going to be advisable to get accounts in, corporation tax computations in as early as possible. Just highlighting also that the Chancellor indicated there's some consultations taking place, again with a view to encouraging investment. The consultation is going to look at perhaps widening the opportunity to claim research and development credits. So the qualifying expenditure perhaps being applied to wider definition of companies, wider definition of costs, and therefore bigger tax savings for qualifying companies. So that's a key area that the government have over the last 10 years, try to encourage more research and development. Secondly, the Enterprise Management and Incentive Scheme is a really valuable scheme to incentivise employees of small and medium-sized enterprises, with the hope to offer them options in the company to retain and incentivise them going forward. The Chancellor's announced that there's going to be a review of that, again looking at a wider application into perhaps a wider definition of companies qualifying. John mentioned earlier about free ports, and the nearest one is Liverpool City region. Just running through the basic advantages of granted to free ports. One, building properties in free ports will qualify for 10% structural and buildings allowances. I mentioned earlier on that the standard rate is actually 3%, so an enhanced rate there. Purchases of property will be possible without stamp duty, land tax applying. Business rates relief will also be available, and there'll be savings for the employer in terms of national insurance costs for eligible employees. And we know that for the next five and a half years, that's going to be available. So I would expect to see quite a lot of activity in free ports, and I'd also expect to see perhaps more regions being nominated to be classed as free ports over the next few years as well. There's been a clamour for the stamp duty land tax holiday that's been in place for a while to be extended, and the Chancellor has listened to that, being extended for another 3 months, and then beyond the end of June there will be some stamp duty available, but at a reduced rate compared to the original position we were in before the pandemic. Just to emphasise though, any purchases by companies still have this extra 3% additional rate of stamp duty land tax applying, even though there's a holiday period more generally. Also, people buying their second properties will still have to pay the extra 3%. I mentioned in last year's budget that there's an extra 2% of stamp duty payable on purchases of property by non-UK residents, and that's in place. That will be in play from the 1st of April. It won't surprise you to know that the revenue are committing a lot more resource, again, extending their powers to deal with tax avoidance, stroke tax evasion. The powers have been extended to look at greater and easier access to information where they suspect there has been some evasion taking place. So one of the issues put forward in the finance bill is that the revenue will be able to issue financial institution notices to enable them to gain taxpayers' information, their bank accounts, crucially without needing their consent. And it's only going to go this way as time passes. And this applies. Originally, those rules were intended for overseas banks, but they've widened the proposal to cover UK banks as well. Another key point that they are looking at is for those selling on digital platforms, eBay and the like, etc. Whereby there's going to be an automatic sharing of information by those platforms in relation to the income of the sellers. You'd have thought that's something that should have been brought in a while ago, but they are now catching up with that. Another indicator of the way the revenue are behaving now is that in certain sectors where they perceive tax loss, they can perhaps gain a better insight in terms of those who may not be declaring everything they should. So I'm afraid taxis, taxi firms, scrap metal dealers are being targeted. So when they come to renew their licenses, they'll only be able to do so if the revenue know that they have been appropriately registered for tax. And again, you can see that the revenue in time will extend the sectors that they will be targeting with that kind of approach. So the key to it, with the changes that we know about and perhaps may be coming on the horizon, is to try and stay ahead of the game. When it comes to the corporation tax rate rise from 2023, if appropriate, it may be worthwhile trying to accelerate profits. It may mean that some provisions that you have in the balance sheet, whether it's for stock or bad debt, you may look to find reasons to release them, accelerate the profits, be taxed at 19% rather than 25%. What that highlights, though, is that more than ever we need to be speaking to each other to actually plan in advance rather than trying to do things after the event. So we know the strong rumours about the possible rise in capital gains tax rates. The Chancellors has put that off for now, but it will happen. Whether how far it goes, we know from the Office of Tax Simplification that they were actually suggesting that the rates could become more aligned towards income tax rate, which we know are as high as 45%. So there was a mad rush for a lot of companies who wanted to avoid the risk of this recent budget raising capital gains tax rate. Companies were being sold, reorganised, etc. Rather than leave it till the next budget, whenever that might actually be, I think people should be looking quite critically at whether they should be bringing forward their disposals, if it's the right commercial decision, but don't leave it to the last minute when the next budget is due. Plan well ahead of the game if possible. So, given the fact that the capital gains tax rates may rise, the focus again turns to the rates of tax, the low rates of tax available when business asset disposal relief is available. That's the new term for entrepreneurs relief. So we know that there's possibility of just paying 10% tax on £1 million of gains. So it's worthwhile trying to maximise that where possible. And one of the obvious areas is to perhaps look at transferring some of your shares to family members so that they each can qualify for £1 million of gains. You may be reluctant to transfer direct to family members, a large shareholding. So one thing might be worth considering is perhaps transferring to them a minimum of 5%, but an extra amount into a trust for that individual. And those two shareholdings together will still qualify for entrepreneur relief or business asset disposal relief if we structure it correctly. So it's worth looking at if you want to maximise the availability of that relief. But what's going to happen, of course, is that people are going to look quite critically into their exposure to capital gains tax, and it will affect people's behaviour accordingly. Some may go down the route of fairly aggressive tax avoidance schemes, not something I'm recommending at all. The Revenue have certainly got it on their radar. They're even targeting promoters of such schemes. But aside from those kind of schemes, some people may look quite critically at becoming non-UK resident. And I can see that building up over time, the take-up on people leaving the UK to avoid capital gains tax. And there the rules are actually fairly clear-cut in terms of being able to plan for non-residency, but it's not something to be left to the last moment. It needs to be planned well in advance. There's opportunity to defer capital gains tax by qualifying investments into schemes such as the Enterprise Investment Scheme, which is Revenue approved. And one other area that's becoming more popular is to sell shares to an employee ownership trust. And if the conditions are satisfied, the vendor can do so without any capital gains tax, not even the 10% rate. So anybody interested in that, we can look towards planning for that. And some people generally will realise that it's not worthwhile necessarily relying on business asset disposal relief. Let's just plan for the long term and perhaps use our holding companies after we've sold our trading subsidiaries, use our holding companies as an investment vehicle for the long term, rather than winding those companies up. So a very quick reminder for all of you to consider your estate planning position. Because of the changes to business asset disposal relief, we may look toward perhaps more shares in trading companies being placed in trusts, where they're not trading companies. Investment companies we can do some planning involving growth shares, and where we have funds to invest, instead of using trusts, we can use family investment companies as an alternative. So just a quick point. It pays for all of us actually to get ourselves organised in advance now. I think the need for up-to-date information and have it early prepared in terms of your accounts, and having a clear plan, short and medium term, makes a lot of sense to do so. Can I just make a quick point about three excellent documents that our colleagues at Pareto Financial Planning have helped put together, which might be useful for owner managers, both in terms of prompts regarding tax planning, pre-year-end tax planning generally, and also having documents that record permanent information for about their companies and their personal wealth. Please have a look at those when you get the chance. We'll have a link to that on the slides. So just if I may, I think I've covered everything I wanted to cover. So please speak to us. There's a lot to do. We need to, if you like, stay nimble in terms of our approach to tax planning, but that can really only be done by early discussions. Okay, so can I then pass on to Lisa to cover issues concerning furlough and other marketing issues. Thank you.
Good morning, everybody. Hope you enjoyed your breakfast and they were all delivered on time this morning for you. Some more further good news on the incentives. So the furlough scheme is here to stay. It's been extended until the 30th of September 21. More good news that it will include additional employees. So those who've made additional RTI submissions between the 19th of March and the 2nd of March 21 will now be eligible for the new scheme. This will include fixed term contracts and those that are covered under 2Pay also as well. There will be a decrease in the government contribution. Effective from April to June, it will remain the same as 80% of the salary for the hours that aren't worked. This again is capped at 2,500. From July, it will decrease to 70% of the hours not worked, with the cap reducing down to £2,187.50. In that instance, the employer will be asked to contribute 10% of the difference so that the employee is still receiving 80% of that pay. In August, the government will contribute 60% of the hours not worked, with the cap again reducing down to 1,875. The employer at this point will be asked to contribute the additional 20%, which does have a cap at 625. Again, meaning the employee will receive 80% until the end of the scheme at the end of September. And just to mention the SMP that SME businesses can reclaim, this is still ongoing and there's no end date for it at the moment. And it should still be paid to all employees from day one of absence. So the first 3 waiting days of sickness is actually paid. And just to note, this is for COVID related sickness absences. And the apprenticeship incentive for adult apprentices has actually increased to £3,000. It's currently sitting at £1,500, but it has increased. And that's been extended for a 6-month period to September 21. Now we're going to cover off a showcase of our website. So those of you that would have joined us some 12 months ago on the last budget, we showcased our new website. We've actually got a new section on there, which is the resource centre, which I'm going to go through now. Okay, so hopefully you can see the website. At the top bar, there's a new section called Resource Centre. And I'm going to showcase the documents that Nadine mentioned throughout his presentation. There is a section down here for financial planning, and all these forms are downloadable and completed online. This one being the in case of emergency file. That's there for you. We've also got other documents on here that would be useful. We have the tax facts that will be sent out in a hard copy as well, but we have got the downloadable version here. So those that received one last year will notice it's very similar layout to what we had last year, And again, you will get a hard copy of that in the post, but it is online for your information. And we've also got a new calculator. So calculators is something that we'll be building through the website as we go. Initially, we've built an R&D calculator, which provides you a simple form to complete to showcase approximately how much tax savings you could save. And finally, just like to showcase our scorecard report that we've got. So this is a report that you can complete. It's got numerous questions in there. I think there's around 20 questions, takes 2 minutes to complete, and it provides you with a summary of your business and hints and tips throughout that and how you can improve and where we feel that your business is standing at the moment. So that's everything from me. Thank you. I shall pass you back to John to close the session.
Thank you very much to Lisa and also to Anne and Nadine for 3 excellent presentations. And can I just take the opportunity as well to say a huge thank you to clients and friends of the firm who have joined us this morning and also for their continued support over the last 12 months, which is of course greatly valued. Thank you. And also I'd like to give thanks to Stuart Waddington, who to my left, who is our IT manager. Stuart has been instrumental in keeping us going this last 12 months and obviously has put all the technology together that's enabled us to speak to you this morning. Now, he has been smiling on occasion this morning, so there's obviously been some interesting material coming through the chat box, the questions. Fortunately, we don't have time to deal with those questions. We're just about at our hour mark. And we appreciate that you're all busy with things to do. However, we will respond certainly to questions that have been raised, as obviously we know who you are. So just I've mentioned the feedback forms. If you can just find a couple of minutes, there's a link in the chat box to complete those, and also we'll be circulating them to you on email. We've 1 or 2 virtual sessions coming up with a payroll update on the 11th of March. Lisa again with her colleague Philip Johnson, and then an IR35 webinar and talked about the changes afoot there. That'll be on the 17th of March. And Ben Davis from the tax team will partner with Forbes Solicitors and give you some advice regarding that. So please, as the Dean said, come and speak to us. We've missed seeing you, but we'd love to see you virtually and talk to you over the telephone. You've heard again this morning many years of experience from Nadine and Anne. Some very good planning points on tax avoidance and how the changes can be turned to your benefit. So I will now close matters formally. Thank you again for your attendance, and we really do hope we'll see you all soon. Thank you.
We have actually got time for a couple of questions that I will run through. There's 4 or 5 that we have got banked up. So the first question that we have received is, do I have to pay tax on my self-employed grant?
Yes, you do, unfortunately, and also on the Small Business Grant Fund. And that was the immediate support that businesses got with a £10,000 rate rebate. These are taxable and they will be included in your accounts when we prepare the accounts.
Okay, and a further question is, when can we claim the grant, the 4th grant?
The 4th grant you can start to claim from April, and the 5th grant is from July claim.
Nadine, one for you. So you mentioned that capital gains tax is likely to increase. What do you expect this to look like?
Yeah, one thing that's worth just mentioning is that you know, we're perhaps in a bit of a bubble as advising clients and businesses. The wider public see capital gains tax as being a little bit unfair in the fact that it is so low compared to income tax. So there's a pressure building up to move to align the rates up to the income tax levels. I don't think they'll go that far, but I can see it going beyond the 20% maximum rate we've got at the moment. So the principles are still the same, to try and anticipate where you're heading in terms of your business, sales, succession, those kind of issues, and actually plan as best you can early on before the new rules come in.
Okay, thank you. And does the stamp duty holiday apply to commercial property?
No.
Okay. Will free ports not simply displace activity from existing locations rather than creating significant new activity? What's your view?
There's going to be some adjustment around those areas. Of course, it will suck in the investment into the free port area, but I think you'll then find that there'll be kind of a ripple effect as well outside that free port area. But yeah, I think that's happened in the past. You know, with enterprise zones that used to be, if you like, similar to the free port principle. That a lot of investment was concentrated, but it didn't actually mean that everything around it also died. There was a ripple effect to it.
Okay, and this is regarding corporation tax. What is your view about splitting business once the limit is reached?
Yeah, but the rules are going to be extended to pick up common control businesses. And if those rules are wide-ranging, having two separate companies instead of one won't necessarily change too much. There may be some areas where there's some loopholes or weaknesses in the legislation, but the government are looking to basically tax commonly controlled companies as though they were one. So splitting them, you'd only really recommend splitting them if it's commercially the right thing to do, not for the tax.
Thank you. Final question. The super deductions for expenditure on plant and machinery is a great step forward, but with no provision to elect and having bring in disposal value at 1.3, it makes super deduction allocation of appreciating assets like property questionable. So it's crucial to understand the future ownership plan. Any thoughts?
Ownership plan of properties. Yeah.
Yeah.
So again, all that this should be doing is accelerating what is the right commercial decision. If you're going to be buying property within the period that super deduction is allowed, but you'll be buying it with the medium and long term in mind. And so long as you don't sell within the 2 years to 2023, you don't get the clawback of that extra 30% that you're getting. But it still has to be commercially driven rather than tax driven.
Just going back to the earlier question about free ports that we had, there is going to be investment into the free ports, and so that will create its own momentum in terms of infrastructure and transport hub around them, with these 8 super centres effectively, 7 on the coast and East Midlands Airport being the final one. And of course the focus of them is in trading with the rest of the world. So if because of the various rules that apply within them, we can make ourselves more competitive, then we are going to attract trade from elsewhere in the world that otherwise we wouldn't have had. So it will do more than displace, and hopefully will significantly enhance.
Lisa, do we have any responses to my inheritance tax nil right then question?
We did. They were anonymous, but we had one correct answer.
Oh, good.
Which was 2009.
Yeah. So because the nil rate band isn't going to change until 2026, it'll be 15 years that it's been set at the same rate in a period when property prices have rocketed. I know there is the nil rate band in a residential nil rate band as well, taking an estate of up to £1 million out of charged to inheritance tax for husband and wife, but even so, it's a long time to freeze an allowance, and it comes back to what I was saying before about stealth taxes. There's more than one way to collect more tax. You don't have to raise rates. You just reduce allowances or don't increase them. So anyway, congratulations to whoever got the answer right. I'm sure they Googled it.
That's the end to all our questions. So thank you for joining us.
Thank you.
And we have put the feedback form in the chat box, and it will follow on email as well. So thank you very much.
Thank you. Bye.
Bye.
Bye-bye.